What is up, YouTube? I'm Adam O'Dell, Chief Investment Strategist of MoneyMarkets.com. And once again, I'm joined by my research analyst, Matt Clark. And we're here for another episode of Ask Adam Anything, the first of 2022. We hope you all had a great year last year and are as excited about the opportunities that we expect the market to provide this year. So let's kick it off with another question we got from one of our subscribers. And Matt, I'll let you put up the question and we'll see what we've got this week.
Thanks. And yeah, again, echoing Adam, I really hope everyone had a great 2021, had a great new year, enjoyed the holidays with family, friends, whatever you chose to do for whatever time off you might have had. We had a great 2021 here. We're definitely expecting an even better 2022, and this is just a nice way to get it kicked off. And yeah, we do have a question. Came in. By the way, I'd be remiss if I didn't tell everyone, if you do have a question that you want Adam to answer, or maybe something that Charles Sizemore or myself can pick up in one of our videos, you can do so by emailing us at feedback@moneyandmarkets.com. We'll put that address down below. I'll talk about it again later. You can also comment down below here on YouTube. And also one other thing, and that is I would encourage everyone to check out Green Zone Fortunes. That is our premium investment service where Adam and Charles and myself and the entire staff work very, very hard to provide you our one best pick every month that will help bolster your portfolio. We'll flash that information up here as well. But definitely want to, if you haven't checked that out, we'll definitely encourage you to do so. But again, yeah, we did get an email from a subscriber, and I'll just jump right into it. It's very, very cut and dry, very straight to the point. And that is, hi, Adam, wishing you had an HHSS New Year. And he means health, happy, safe, and sound New Year. Here's my question. When a company decides to repurchase some of its outstanding common stock, what are its reasons to do so? And what kind of benefits can the shareholders get from such a situation? Thanks. And that question came from Vincent. Vincent, thank you for asking and for doing so. We're going to try to hook you up with some Money Markets gear, like maybe a t-shirt like what I've got on here, or a sweatshirt. You can't really see it, but I've got it hanging on the back here, maybe a hat, something like that. We're pushing the boss to get more stuff. He's working on it, but we will get in touch. A member of our team will get in touch with you. But Adam, basically the question revolves around share repurchases. Why do companies do it, and what kind of benefits do share repurchases have to shareholders of that company's stock?
Yeah, this is a great question because it's something of a topic that's a little bit misunderstood by a lot of investors. But basically, share repurchases happen when, so a company is earning earnings, money, and they have net cash from operations left over. So over time, quarter after quarter, month after month, that cash builds up, and they have a cash balance on the balance sheet. And so the question then becomes, what does the CEO, CFO, what does the C-suite, what does the management team want to do with that cash? Now, some companies need that cash to invest in their business, to grow their business. They maybe need, capital expenditure. They maybe need to put that money toward building a new plant so they can increase their production capacity and therefore increase their revenues. And so if there's a good use for that cash to grow the business, then that's typically what management will do. However, there are some companies that don't need a third or fourth or fifth factory. They don't need that cash. And if that cash just sits on their balance sheet, it's what's considered an unproductive asset. It's just sitting there as an asset, and it's good for a rainy day. Let me say that. It's good to have a cash balance. We rate our Green Zone Fortunes stocks based on 6 factors. One of them is quality, and one of the metrics within that quality score is basically the relative amount of cash they have on the balance sheet relative to how much debt they have. But that said, a company can have too much cash on its books, and that becomes an unproductive asset. And then at that point, the management team is kind of incentivized or has a good reason to return that cash to shareholders. Okay. And so returning that cash to shareholders through stock repurchases basically involves the company repurchasing some of the outstanding common shares of stock that are floating around in the market, repurchasing those shares. And so their cash balance goes down, and also the number of shares outstanding in the market goes down as well. Now, typically what will happen when that happens is the share price will increase. Okay, so particularly for a company that has committed and the board has already approved a share repurchase program that is large enough and consistently long enough over the course of time that investors can bank on that, that typically will bolster the share price of the stock. And so shareholders, well, the question was, how did shareholders benefit from that? Well, shareholders, if you're already in it, then as the share price is increasing, obviously you have capital gains capital appreciation on that stock. So that's how they benefit. So it's really just a matter of, a company having too much cash. They don't have a good use for that cash to invest in their own business. They don't need another factory. They don't need to spend more on acquiring customers. So they will return that cash to shareholders. And it's typically a very good thing.
Now, it kind of brings up another question that I have to follow up on, and that is, a lot of times if you read financial news websites, and we all do, a lot of times when you read about these stock repurchasing programs that boards approve, Wall Street tends to take a bit of a sour look on that. And why is that? Why does Wall Street, if this is something that basically the company is doing to alleviate some of its cash off its books, it's not a bad thing. Why does Wall Street sometimes interpret it as such and even sell off some of the stock to drive the price down before the repurchase happens?
Yeah, this is actually a really interesting topic, and it's one that I've struggled with for years, figuring out why are people so against share repurchase programs. Meanwhile, people love dividends. I mean, there's a whole throng of investors out there they call themselves dividend investors, that just love getting that drip of dividends in their account on a monthly or quarterly or semi-annually basis. So basically, the first part of your question, why is it viewed with a dubious eye? And so basically, earnings per share is one metric that a lot of analysts look at. Every single quarter, companies come out and they report all of their financial metrics, and earnings per share is one of the ones that's looked at very closely. When a company repurchases their shares through a share repurchase program, the number of shares outstanding is decreased, okay? So when you take an earnings per share metric, the number of shares is the denominator, it's the number on the bottom. And if that number goes lower, meaning there's fewer shares outstanding, then the earnings per share metric goes higher, even if the company's earnings have stayed exactly the same from quarter to quarter. So there are some, bad actors in the industry, and there are some C-suite executives whose compensation is tied to metrics like earnings per share. So if you are one of those bad actors and you are a CFO of a company and you know that you're going to get a bonus if your earnings per share goes above a threshold or has a certain growth rate, then you may be incentivized for your own personal gain to decrease the number of shares outstanding through a stock repurchase. And therefore, regardless of what your earnings do, or even if they don't go up, your EPS metric is going to go higher and you make your bonus. And that's why a lot of people look at share repurchase programs with a dubious eye. That said, I think that's the exception rather than the norm. I tend to believe that most corporate executives are in it for the right reasons, and they know that long-term investors will judge their long-term performance, and they are really just using capital allocation strategies the best they can. If they need to invest in a factory or customer acquisition, they will. If they believe that their share price is a good value, if it's trading at a price to earnings, a price to sales, or price to book ratio, that they would buy that stock if they were just a regular investor, then a share repurchase program can be an absolute great use of that excess cash. And it treats shareholders well. So I think it's a good thing. It's always confused me why basically they're the same. They're the two sides of the same coin. Basically, whether you give shareholders actual cash in their account from the dividends, and then the shares reprice lower after the ex dividend date, or whether you buy shares in the open market and retire them as a share repurchase program, all that does is return that cash to the shareholder in one form or the other. So it's really, I don't see the bias against share buybacks and the preference for dividends, but nonetheless, you really should look at both. You should look at what a company is doing with their cash. If they have a lot of cash on the books and they're not able to increase their capacity, why aren't they using that cash? If they're repurchasing their shares or returning it to shareholders through dividends, that can be a great strategy as well. So that's how I see it.
Here's a bit of a curveball for you, and this digs more a little bit into the business side of things. But is there a situation, and if so, what is that situation where a company would have a lot of cash on its books but not repurchase its shares?
Just the same reasons that you and I have cash set aside for a rainy day. And that's, it's basically, it is an unproductive asset, but it's a safety asset. Okay. So, things change quickly, and right now, stock prices are looking good, and the economy seems to be humming along just fine. There's certainly disruptions in the supply chain and everybody's worried about interest rates. But nonetheless, I mean, if you have cash set aside for a rainy day, that can give you peace of mind that you can kind of get out of the quarter to quarterly reporting trap and look more long term and know that you have the cash on hand to fund whatever future investments and ventures you want to do. So that would be the biggest reason to have cash on the books and not necessarily use it. But that said, every company is different. If you have no debt, then you probably need to have a smaller cash hoard. If you have a lot of debt and some of that debt's coming due and interest rates are rising and you think that you might have to refinance at a higher rate, then you probably want to have a bigger cash hoard because you're gonna have to use some of that cash to pay the interest on the new debt at a higher rate. So it all depends on the situation, but that'd be the biggest reason, a rainy day.
And all in all, what you're saying here is that, investors, whether they are, institutional or retail, should not look at a stock repurchase necessarily as a bad thing. Because it will mean one of two things. One, that the stock repurchase will help push the stock higher and thus give us, the investors, more of a gain. And it also helps the company with its balance sheet in removing some of that cash and some of that unused asset in that unused asset class. And so it actually helps its financial performance a little bit. So it should be looked at much better than I think what traditional, maybe mainstream Wall Street media may look at it, or mainstream investors may look at. So definitely a great way to put in perspective what stock repurchases look like and what they're for and why investors should actually pay attention to them. Adam, appreciate that. Vincent, thank you so much for the question. Again, for asking that question, our team is going to hook up with you and try to get you hooked up with some money markets gear, maybe a shirt, a t-shirt here, hat, sweatshirt, all the above. And then we've got some more stuff on the way too. But again, thank you. If you do have a question for Adam that you'd like to ask him during this series, or maybe one for Charles for our Investing with Charles, or myself for our Marijuana Market Update, or just a broad general question you'd like to ask, do so. You can do so by emailing us at feedback@moneyandmarkets.com. Put that email address right down there, or you can comment below here on our YouTube channel. We love to get feedback. We love to see your questions, and we love to answer them as often as we possibly can. Also, Adam, Charles, and I work very hard, as well as the rest of our team, every single month on our Green Zone Fortunes premium investment service. Definitely want to make sure you check that out if you aren't already. It gives you we comb the stock market every day, and we look for that one stock that we think is going to bolster your portfolio. I'm not going to get into its performance. It's really good, by the way, but I'm not going to get into that because I can't. But I will tell you that you will not be disappointed. We'll flash a link on how you can find out more about that. Adam, certainly glad to be back in touch with you after the new year, and look forward to a very strong 2022. Thanks.
Agreed. Thanks a lot, Matt. Take care.